Hello and welcome to Pro Trader Strategies Market Commentary for Wednesday, July the 15th. I'm Eric Wilkinson, and yes, you very well may recognize me from mainstream media where I've talked about the economic data, the geopolitical environment, and how that impacts the overall markets with my market analysis. And I do the same thing in these daily market commentaries, but I go a little bit further and layer on top of it these option strategies I find in order to implement into my portfolio according to those market analysis that I come up from the geopolitical and economic data. Anyway, without further ado, make sure that you check out the daily market commentaries and the webinars that I do on Thursdays, because on Thursdays I go into the nitty-gritty on these option strategies and talk about how you need to implement each and every option strategy according to the environment that you're finding in and around that underlying that you have an assumption in, whether it's bullish or bearish. We need to make sure that we're following a guideline in order to increase our probabilities of success. All right, so without further ado, let's get on with the economic data. Across the pond, we do have some good economic data coming out from Europe. We got the 10-year bond auction, came in a little bit better than what was expected. And then we moved back over here to the United States with a lot of economic data. We got the Empire State Manufacturing coming in at 17.2, better than the expected 10.0. Importer prices coming in at 1.4%, expected to be 1%. You know, that's an inflationary gauge, and that's something that most people tout as being a good thing when we start seeing inflation rise. That's not really something I really love to see necessarily. Industrial production, though, coming in at 5.4%, expected to be 4.5%. And then we got capacity utilization. This is how much, at 100% would be basically manufacturing going 24/7. But we've got 68.6% in capacity utilization, expected to be 67.9. Sorry, 68.6. I don't know if I said that correctly. And then moving into today, we got the crude oil inventories coming in at a drawdown of 7.5 million barrels, expected to be a drawdown of 1.3 million barrels. Something to note with crude oil as well today, we've got an OPEC meeting. They are expected to roll back some of those cuts that we've talked about so much about. They're going to maybe start ramping up production based on the fact that there is a global opening and they expect the demand to come. I'm kind of in the camp where we may have seen the peak in crude oil demand, at least for this summer, maybe going into next year, as I think more and more people are going to kind of be staying at home. We're starting to already see some more lockdowns happening. People in California, their kids aren't going back to school, so they're going to be stay at home. How does that impact the overall market? I think it's going to make it a little bit more sluggish, because what are parents supposed to do? I talked about this yesterday. They can't get back to work if they've got kids sitting at home, especially in elementary school and things of that nature. Keep in mind, later on today, we do have Beige Book coming out. Not a lot of people look at that economic data point, but I think it is very important. Why? Because the FOMC gets something that's called the Blue Book, and it happens right before the FOMC. This comes out about 2 weeks ahead of time, but it does give us a bit of a snapshot as to what they're going to be looking at. Yes, it is a combination of most of the data points that we've already seen, but it's still going to be pretty important to see that economic data point coming out, because then you got a better picture as to what interest rates are going to do based on what the Fed is going to see in a couple of weeks. All right, so getting on with the overall markets, we can see here crude oil back up about 30 cents right now, holding on to 40, and I probably will hold on to 40. I was expecting it to roll back over, I'm not going to lie, but with that economic data point on crude oil inventories, even distillates and gasoline had a drawdown. Gasoline, I think, was a drawdown of 3 million, meaning people are getting out and starting to drive. Distillates down just slightly less than 500,000. That's showing that manufacturing is starting to pick up. All right, so because those distillates go into like polypropylene and things, plastics, and that's usually what the manufacturers are demanding for manufacturing. So we go on to the bonds. Bonds are off by about 13 ticks here, back below that 180 handle. I've always talked about the 180 handle as being very important. Thought maybe we might start to see a really price increase here in bonds as the printing. We're starting to see some inflation. Fed doesn't expect to raise interest rates anytime soon, and we might see another round of stimulus coming, which means printing of more money, weakening the overall dollar. And when you see the dollar start to really weaken, we start to see interest rates go down and the bonds start to go up. So we'll have to keep an eye on that here. We got a real mixed bag going on over in the equities. We've got the gold futures about unchanged, holding on to that 1800 area. But we are near the lows of the day, although we've got the Dow Jones Industrial Average probably leading the way right now, up 171 points on the day. But this chart pattern not looking so rosy right now. It looks like we might start to revisit the point of control here coming up relatively soon. Is probably going to have a lot to do with the economic data. And something to else note, we did see the markets really move higher earlier today, and we're coming off of that euphoria. But something, Moderna was coming out with a vaccine. They are starting trials with like 30,000 people. Pfizer says they have some real promising results for some vaccines as well for COVID-19. That gave the markets a bit of a boost earlier today, but I think we're starting to see some of that euphoria come off. Another thing to note, we've got that mixed bag. Well, that's the NASDAQ coming off here by about 52 points, while we got the equities in the Dow Jones and the E-mini S&Ps higher on the day. So that's following in line with my thesis that this stay-at-home trade is starting to lose a little bit of momentum, as especially with things like this, these virus or vaccines coming out. That's going to weaken that stay-at-home trade that we've talked about so much with Google, Microsoft, Adobe, EA Electronic Arts. So all of those starting to see some weakness here as people are starting to look forward to that stay-at-home trade maybe not being so strong heading into the latter part of 2020. Therefore, we're also seeing some robustness happen in some of those blue chips. And I've been talking about this for a couple of weeks. Yeah, I have been wrong. I've been ahead of that game. But the fact of the matter is that's really the signal of what we're starting to see here. And I've been talking about that for a while. Yes, I'm always early, it seems like, to those things where I feel like I'm one of the first people that starts talking about it sometimes, and then I jump on board with my thesis there, and sometimes it's a little bit early. And we've got the E-mini S&Ps holding on to 3,200, although we are near the lows of the day, but we're still positive in the Dow Jones, E-mini S&Ps, NASDAQ showing a little bit more weakness than the broader markets there. And then let's talk about a couple of, let's break down the E-mini S&Ps on the 30-minute chart here. Pretty much the euphoria overnight of all of the information coming out about the possibility of the vaccines for coronavirus. So you can see that we've got that move higher coming into today, really flushing out those longs from the overnight inventory. Now that's a pretty good sign when we see that flush out. Now that we've done that, I think we're going to see the E-mini S&Ps maybe make a bounce here as we're starting to try and make that recovery right now, and people starting to do that bit of a sector rotation out of tech heavy and into some of the smaller stocks like in the E-mini S&Ps that haven't had that run up like we saw in the tech, that parabolic move in the broader markets over there for the stay-at-home trade, and now starting to see some sector rotation into things that are the blue chips there. All right, so Tesla, again, they're kind of in, not really, they're a tech-heavy company. I mean, the only way that you can say that this car manufacturer is worth more than something like Toyota, where they make 10 million cars a year and Tesla only makes about 500,000, is that they are a tech-centric company with the autopilot, for lack of a better phrase for that. But we're starting to see some weakness in this market as well. We go over and look at something like Adobe, again, seeing some weakness the last few days as that stay-at-home trade starting to lose some of its momentum. With that being said, I did go into the NASDAQ ETF, which is the triple Qs, and played this to the downside, throwing in there some calls, some short calls in there. You can see right now we got a high implied volatility. Yes, it's not quite as high as what we would normally see, but the fact of the matter is it is still in the like 35 percentile, IB percent of 35, which for my rules or my guidelines with these strategies is anything above 34 in ETF. We need to start looking at selling some premium because that's where premium is very elevated. Are we going to see that kind of volatility we saw back here in March where we started seeing those lows? I think that might be out of the question because that was really unknown. And now we're starting to get more data around this pandemic. And I don't think that we're going to see that major spike in volatility anytime soon. So we can start looking at that as being more of a black swan event. Do I think that we might go a little bit higher in here and maybe head up into the 56 implied volatility? Yes, that's possible. Keep in mind when I'm talking about implied volatility percent, I'm not just talking about this. It does line up with what I was talking about, that the triple Qs is a 35.5 implied volatility percent. This is implied volatility, but it's not showing us anything other than where it is currently. What I'm talking about with implied volatility percent is where it's been in the past. So in that, I decided to go in and sell some calls in here, and I did it small. I'm adding negative deltas. Yes, I already did it with the SPY. I do think that, you know, the NASDAQ and the broader markets might pull down the SPY and wanted to add some negative deltas in there, but I probably should have gone into the NASDAQ instead. And so I decided to go in there and do the October. In SPY, I am long puts, but this has higher implied volatility percent than what we were seeing over there in SPY. So with the NASDAQ, I went in to triple Qs and did this, the October, sold the 300 calls in there for $2.04. So I'm looking for this bit of a pullback. Yes, I am going to have a very short leash on this trade. We start seeing any type of move higher, that is going to be something I'm going to look to roll out of. But right now we're also seeing some of those travel stocks, travel and leisure, start to make a bit of a, trying to make a bit of a push. It's not anything dramatic at this point, but we're starting to see some inflows of money to those. I'm going to stay away from that right now. I don't know that we're out of the woods yet, but I do believe that we're going to see some of these parabolic tech stocks make a bit of a correction as people are going to look to book some profits and roll into something that has not participated in this move. So playing that right now for short calls in triple Qs. Other than that, I haven't added anything to my portfolio or taken anything off. Pretty happy with the way the market's treating my portfolio today. So I'm going to leave those on and let that ride. Other than that, check out tomorrow's webinar on the roadmap to implementing options. I'm going to drill down on the nitty gritty, like I said, on how to implement these options into a portfolio based on an assumption. And we are going to start out with that assumption and then find the right strategy for it. So a little bit different than most people will do. They're usually going to pull a strategy out of the hat and kind of just throw it in there based on their assumption. That's not how we do it here. I'm going to teach you how to set up a strategy correctly in order to implement into your portfolio so that you have higher probabilities of success. And options are the best way to increase that yield in that portfolio. All right, so without that further ado, please make a note to go over this disclaimer, because we are an educational company and I am not here to solicit any of these trades that I've talked about with the triple Qs or Tesla. What I'm trying to do here is talk about my trades and how I'm following those guidelines in order to increase my probabilities of success. Why we're buying puts on a bearish assumption or selling a call. We need to know what the environment is in and around that underlying and pick the right duration. So I'm giving you all of those things in these webinars. So check those out at protraderstrategies.com. But please take a moment to go over this disclaimer here. All right. If you can't take that, take it easy.